Hi, it's your realtor Dave with another exciting topic in the real estate world. We're going to be talking about President Trump's plan to lower mortgage interest rates. But before we get into it, if you can hit that subscribe button, it'll help keep you up to date with the latest and greatest in the real estate world. Now, we are currently witnessing the most aggressive government intervention in the housing market since the 2008 financial crisis. Between President Trump's massive $2 billion mandate for Fannie Mae and for Freddie Mac, and the looming departure of Fed Chair Jerome Powell, the rules of the mortgage game are being rewritten in real time. Now, if you've been waiting on the sidelines for rates to drop, the next 90 days are going to be the most volatile and potentially rewarding window that we've seen in years. Now, as of late January 2026, we are finally seeing some daylight. The average 30-year fixed mortgage rates have dipped to around 6.09%, with some high credit borrowers even seeing offers starting at 5% for the first time in nearly 3 years. This is a massive improvement from the peaks when we battled through recently. But while rates have stabilized, the lock-in effect is still real. Millions of homeowners are sitting on 3% rates and refuse to move. To break that fever, the White House has decided to stop waiting for the market to fix itself and has started pulling the levers of power directly. On January 8th, President Trump issued a directive that sent shockwaves through the bond market. He ordered Fannie Mae and Freddie Mac, the giants that back most of the U.S. mortgages, to use their $200 billion in cash reserves to purchase mortgage-backed securities. Now think of it like this. Mortgage rates aren't just set by the Fed. They are determined by how much investors want to buy mortgage debt. When demand is high, rates go down. By forcing Fannie and Freddie to become buyers of last resort, the administration is artificially creating massive demand. The goal here is to compress the spread. Usually mortgage rates stay around 1.7% above the 10-year Treasury yield. Lately, that gap has been much wider. This $200 billion injection is a surgical strike designed to force mortgage rates down by an additional 25 to 50 basis points without the Fed having to move a muscle. We already saw daily rates flash into the high fives immediately after the announcement. It's a bold, interventionist move intended to jumpstart housing affordability. Now, while the White House is pushing the gas pedal, the Federal Reserve has its foot on the brake. But that foot is about to change. Jerome Powell's term as Fed chair officially ends May of 2026, and the transition is already causing market jitters. The administration is looking for a successor who is more dovish, meaning someone that's more likely to slash interest rates to fuel growth. Names like Kevin Hassett and Rieder are at the top of the list. Now, markets, they hate uncertainty. Between now and May, we expect a lame duck volatility. Jerome Powell is likely to hold rates steady to protect his legacy of fighting inflation, while the incoming chair will likely be pressured to start a series of aggressive cuts this summer. If you are looking to refinance or buy, the period between May and June, the leadership handoff area, could be the Goldilocks Zone, where political pressure and market shift align to create a rate floor. So what is the bottom line? Most major analysts are projecting that the 30-year fixed rate will settle between 5.5 and 5.75 by mid-2026. However, there's a catch. With the government spending billions to prop up the market and a potentially more political Fed, there is a looming risk of reinflation. If the government pushes rates too low, too fast, home prices could take off again. We might be heading into a buy now or pay more later scenario where the rates drop is offset by a spike in competition and home prices. The 2026 market is no longer about waiting for 3%. Those days are gone. It's about navigating the 5% range and timing your move before the next wave of buyers flood the market this summer. If you want to see exactly how these new Fannie Mae policies affect your specific loan estimate, or if you want to be on my rate watch list to catch up to the sub 6% window the moment it hits, click on the link in my bio and shoot me a message with the words rate. I'm tracking these political shifts every single week so that you don't have to. Now let's get into your next home before the rest of the world catches on to what we got to do.